Hey everyone, it is Evan here from the Trade Risk on Tuesday, March 3rd, here with a midweek market recap video. We're going to cover all of the major markets and the current market environment. So volatility is here to stay. Another wild week. Monday to open up the week, we had one of the largest up days in history for the major averages, up around 5% across the board. This today, of course, today on Tuesday, you can see we gave up about 40 to 50% of those gains of the rally made yesterday. The Fed stepped in today, announced a surprise sort of 50 bip rate cut. And I mean, the surprise probably more so on timing than the actual cut itself, but still a bit of a surprise for the market. Initial reaction was higher. Of course, you can see how we closed on the session, though, firmly in the red. So let's try and make sense of this. We're going to look through a couple of things today. Try and answer some questions and make sense of what's going on here. If we look at the numbers on Tuesday, you can see firmly negative 2 to 3% right across the board to the downside. 5-day change numbers also still firmly negative, anywhere from 2.5 to about 5.5% negative over the past 5 days. And we are still below the 1050, 200 SMA across the board, except for the NASDAQ, which is trying to hold on to that 200 period simple moving average. If we look here at sectors, you see a little improvement based on where things were on Friday. Biotech still at the top of the list here, almost going green, but still negative over the past 5 days, followed by semis and tech. And on the downside, we have transports, energy, financials, anywhere down anywhere from about 6 to 8.5% over the past 5 trading sessions. In terms of major markets, volatility is still at the top of the list here, up 30%, followed by safety haven of fixed income, the long end in the middle of kind of the curve here of the spectrum, so 20-year plus all the way into the 10 years at the top of the list. And also look at number 4 here is China. So the Chinese ETF FXI up 1.84% over the past 5 days, quite interesting there. And on the downside, we have oil, we have silver, and we have S&P 500 all down anywhere about 4 to 5% over the past 5 trading sessions. So let's jump into the charts here. And I want to first start, the question I've seen getting thrown around a lot on social media and some questions that I've received is whether or not we have to retest the lows made yesterday. I'm sorry, not yesterday, the lows made Friday. Does the market have to come down here and retest this? And, this is it's a sort of a question that almost can't be answered because it really depends on what your definition of a retest is. Does it have to be exact? Does it have to undercut? How close does it have to be? In what time period, does it have to actually retest within? So there's all kinds of questions and all kinds of context that actually matters if you're going to really try and answer that question. But what I thought would be interesting, at least, would be just to dial back the charts here and just go back in time the past decade, and quickly look at some of these past examples of when we've had violent sell-offs and whether or not they've been retested to help try and inform or to help try and answer this question. Now, the one thing that is interesting, though, that does sort of separate and make this fairly unique, this recent sell-off last week, is just the speed at which we sold off. So we basically, if we look back, as we're going to look back in history here at prior sell-offs, I mean, most of these sell-offs that get anywhere to, 15% off of highs take place over multiple weeks, sometimes multiple months. And we've seemed to basically do all of our selling in just 6 days worth of time or 7 days worth of time this time around. So it is kind of interesting just to see how fast the sell-off was, this time around, but nonetheless, let's just take a look at some of the past examples here on pullbacks and retests. So I think the first place where we kind of, attempt to answer this question is right in here at the end of 2018. So if you recall, we were kind of going up in this uptrend. I'm going to try and move through these quick just because there's a lot of examples, but, we're in this uptrend. We had this 4-week pullback, and then what you saw happen was there was no immediate V-shaped rally higher. We we ended up chopping around. We went sideways here for about 6 weeks, and that led to another leg lower. That leg lower never got retested, right? So we can see the lows here. We're right on Christmas Eve. You can see we came all the way down to 23.46, never got retested again. It just went off to the races to the upside. So the one difference here is that it wasn't just one clean swoop down. It was leg down, sideways consolidation over a month, and then a second leg lower. If we look at the pullback here in early 2018, this did get retested. So we were in this uptrend. We had a 2-week violent sell-off here, get a low all the way down to this point here. We retraced for about 5 weeks. We came back down and we retested. I consider this a retest anyway. Some may not. So again, this is where definitions become important. But we effectively retested down around this point here, and then we went off to the races. So no retest here. Yes on the retest there. Let's see what else we can find if we zoom back here. This one I'm not going to really count just because, again, it was so gradual here. If you want to consider this one, then, I guess you have no retest on that. If we look at 2016 and 2015 zone here, so 2015 was a very choppy year for the market. This was the first kind of violent, pullback off of highs right here. And then you can see basically 3 weeks later, it was retested. And then, it bounced up, it came back down, and, you could almost argue this is either another retest or just a fresh set of retests. Either way, this time around here, you basically had another retest of the lows. If we scroll back even further, we get to 2014, and what you see is we pulled off here, and we had no retest. We went totally on a V shape here, and we did not come back and challenge this bottom or test that bottom. If we go back even further, go back to 2012. You can see again another no retest moment here. This pullback's a lot more gradual, taking place over 6 or 7 weeks, but no retest. Same thing here in 2012, no real retest here on this pullback. And if we go back just a little bit more before we call it quits, 2011, this one did have a pretty violent pullback, and it was retested just about several weeks later, right in here, but it did go sideways and chop, and then basically was tested there. And one more in 2010, you can see pulled back, chopped around, tough one here. Looks a lot different than what we currently have just because of how gradual it was. So this is basically a lot of sideways chop with, mostly just chop, no real clean retest there to think of. So all in all, it is a very tough exercise and question to answer because, things look different in the past. But I think we can clearly say that markets do not have to retest lows. It is not a requirement. It does not always happen. We saw plenty of cases there where markets just V-shaped and got left behind. There's basically 2 scenarios that I think that can unfold here, and really this is just the way markets work. I mean, there's basically only 2 things that happen here, is that the market is either going to completely V-shape and continue to go higher, or extend lower and then V-shape, or something to that magnitude, or the more likely scenario is probably just sideways chop, right? So just a range here where the market now absorbs and tries to digest the shock that just happened to the system last week, and we just end up bouncing around. It could be a wide range, it could be a more narrow range, but basically we just go sideways here for multiple weeks or multiple months at a time. I think those are basically the 2 sort of situations that we're looking at. If we want to think about some levels that we can look at, I put up this, or I annotated up this view here, and I put on some percentages just to get an idea. Again, not predicting any of these things, but basically, at the lows here, we had about a little over 15% correction. If we came down to this line here, which is 27.46, this would be approximately a 19% pullback off of highs. But effectively, these levels in here are all levels that really mattered before in this range, because as we get below the lows made from Friday, we have a lot of previous supply to sort of look at and measure against how markets reacted at these prior levels. So for me, the big line in the sand, of course, is this 28.72, or approximately last Friday's lows. I think that is what we're all paying attention to at this point. Of course, we just tried to answer the question, do we have to retest past that area. I think ultimately the way you want to think about that area is just a level to trade against, or to measure risk against, because that is our benchmark going forward. Is we need to look at last Friday's lows. This is a point at which the market ended up reversing. So we know that's a significant point at this point in time. So that's our level where we can sort of measure some risk against, and try and make sense of what's going on here in the next couple of weeks or so. So 28.72 down to 28.55. That is the area that I'd be watching there on the downside. And then if we start breaking below there, we start opening up to more of these levels down here. 27.46 or so. It's a big range to hold. I do think there's a bit of an air pocket down here. If we do manage to really accelerate this movement to the downside here, if this story gets worse, if the market continues to price in increased fear and disruption in the whole supply chain just spread out through everywhere, then of course, below 27.46 or so, I think that's where things get really ugly. We're certainly not there yet, and we don't have to be there at all, but those are some longer term levels to pay attention to. In the short term, I would expect, especially with a VIX that continues to trade at historically high levels, a 37 on the VIX is something that we don't usually see persist for long periods of time. But until the VIX can actually start to come back down to earth below 30, below 25 or so, you need to consider that ranges are going to be wide, volatility is here, and should expect big moves really in both directions. So watch the VIX. I think that's equally as important going forward here, as a good barometer of what the market's pricing in terms of fear. So long as it's above 25 or so, then I think you still need to just, as a trader, be aware of the risks, frankly, in both directions. So that's sort of the way I'd look at it here. Retests doesn't have to happen. Think in terms of maybe a higher low might be a better way to think about it, or look for that next low. If this is the low here, then let the market settle in, even if it dances around and goes sideways for 4 or 5 days, and wait to see if you can get a higher low that gets put in, ideally above 29.38. That'd be great. If we don't come back down and retest entirely, but put in some type of higher low, that would be some good conviction there, be some good structure to start to work against. Remember, you just don't have to rush out and trade. The best course of actions for a lot of traders, frankly, is probably just sitting on the sidelines, waiting for this to play out, and waiting for a more sort of normal, calm market. That is, of course, unless you do like the volatility, unless that is part of your trading system, and you do find opportunity in high vol markets, then you're having fun. This is the market that's good for you. But for a lot of people that are looking for lower volatility trend trades and swing trades to the upside, this really is just not situated for you. So consider doing less, sitting on the sidelines. We got our levels to look at. We know that we don't have to retest, but we should be keeping an eye out for some type of higher low, and we're going to be watching the VIX to let that gauge and inform our decisions on in terms of when maybe the worst is behind us. So those are all some different tidbits there, hopefully useful information and ways to kind of frame out this market. If we continue on and look at some other major markets here, you can see the IWM. If we go down to a daily chart, found some support, stopped selling off right at multi-year lows down here around 145. Again, I think this is a very important level to hold. If we start closing below Friday's lows, if we start losing Friday's lows, then you have to be cautious here in these markets. If they continue to bleed lower, if they continue to sell off, that means fear is not contained right now. Selling's not over. So watch those lows from Friday. IWM still kind of weak here and not trading all that far off from where we stopped just 2 days ago. If we go to the Qs next, you can see Qs faring maybe a little bit better here. They've got a little more distance between the lows from Friday to where it closed right now. Again, just pay attention to that 200 level or around 199. That's what I'd be watching here in the Qs. If we go to a weekly chart, you can see, of course, coming back down and stopping and retesting at a very longer term sort of breakout point for this market. So Qs, I think this is an important zone to hold as well. If we start losing 199 or so and start falling going back into this old range, then we get some bigger problems, deeper pullbacks to keep on our mind. So that's the market in a nutshell there. If we go to some other major markets, you can see TLT is one of the few things that really has just continued to march higher here. Bond funds basically across the board, whether you're looking at TLT or shorter duration, are all moving up as yields come crashing down to historic low levels. TLT putting in a tremendous amount of volume over the past 3 sessions. You can see based on the way this finished off the day here, maybe some short-term climactic action here where this has gotten quite vertical. I know if we put on Bollinger Bands here and we were to look at what this looks like on, say, a weekly time frame, I think this is something we charted on last weekend's video. TLT doesn't like staying outside entirely of the 2 and 20 standard weekly Bollinger Band for too long, and right now it is going on its 2nd week above it, so it'd be interesting to see how long this can persist, but if there is fear out there, then this is the best house to park your assets in right now is TLT. So you know, continues to look good. It's stretched, tough to chase, but it is working in this environment. If we go down to gold, you can see gold is starting to lift back up again. Had a strong session to the upside, 3%. Had a rough last week just in terms of you know, in terms of relative outperformance, it still did well last week, but in terms of absolute performance, it was still down, and came right back down and sort of retested this consolidation. It seems to have held, at least in the short term, trying to bounce back up now. Long-term trends all still up here for gold. Good volume coming in, so we'll have to see if this can stick and continue, but, you know, basically over 147 is where you want to see gold continue to hold above. And silver also was up today, up almost 3%. Still, this one here, quite messy as well, really kind of breaking some structure here and kind of reclaiming maybe the lower end of this range, but silver just more in the penalty box in my book. Looks kind of messy here and not so interested at this point in time. Last but not least, if we look at energy, oil did manage to snap back this week as well. You can see looking, you know, like it wants to continue to hold. It rebounded. It closed on its closer to its highs on Friday, had that strong session right along with the markets yesterday on Monday, and then it did hold on to the majority of gains today, unlike equity markets. So USO is trying to hold in there, snap back from extreme oversold levels, and natural gas also snapping back today, coming back into this consolidation here. Still get some good momentum divergence at the top here, but natural gas, of course, has been, you know, a drastic underperformer and has been downtrends across all time frames, so you have to be cautious here, but nice to see that it's at least back in this zone. Now you need to get it back over $15 and maybe you have some short-term bottom to work against. So that's it. That is the whole recap here for the middle of the week. Lots going on here, lots of volatility. Remember, with a VIX at 35 or 36, that is much different than all of your past markets that you've seen over the past, call it 6 to 10 months, 6 to 8 months, with an environment of a VIX below 18, much different than a 36 VIX. So again, be careful, especially if you are a newer trader out there that hasn't seen this type of volatility. It's time to just adjust your plans and look at that position size, risk management, and all that fun stuff. So that's it for me. Thanks as always for tuning in and watching. Every Tuesday, every Friday, market recap videos just like this. Have a great rest of the day. We'll see you back here tomorrow for some swing trade ideas during the market session.